Welcome back to the channel. Welcome back to another video. In today's video, we're going to talk about the CPI inflation report for September and how I believe it's going to affect the American people going forward. But before we do that, let's get some house cleaning items out of the way. Number one, here in Southwest Florida where I live, guys, it's windy today, so forgive me if we get any interruptions from the wind. But I enjoy being outside and doing these live streams, so hopefully you guys will be able to see me clearly and hear me clearly. But before, like I said, before we get into the CPI inflation report for September, I need a couple things from you. Number one is, please, if you don't mind, hit that like button for me. It's real important to hit that like button as you come into the live, come into the video. That's the way the YouTube algorithm helps push this content out to more people. The more engagement we have from likes, when you hit that like button, the more the YouTube algorithm will spread this content out to more people. So please do me a big favor. Hit that like button for me. I really would appreciate it. Also, if you want up to 12 free stocks from Webull, there's a link down in the description box. Webull is going to give you up to 12 free stocks when you open a new Webull brokerage account. Put any money in that brokerage account, any amount of money. They're going to give you up to 12 free stocks for just trying out their brokerage app. Like I said, that link is down in the description box of the video. Keep in mind, guys, I also use Webull every single day to transact my paper asset transactions. Whether I'm buying or selling paper assets, I use the Webull app, the Webull brokerage account through the Webull app in order to make that happen. So rest assured, I'm not asking you to try something that I'm not using on a daily basis, and I have been using it on a daily basis for about 2.5 years. So that link is down in the description box. Like I said, open that Webull account, go get that free stock, go get that free money. Also, I'm gonna send you a free Webull tutorial video that will walk you through how to use the Webull app in order to start buying paper assets like ETFs and individual stocks. All you gotta do is send me a DM on Instagram at RichardFain28. I'm gonna go ahead then and send you that free Webull tutorial video. Now, you can find my Instagram username down in the description box of this video as well. So go down to the description box and you'll see something that says Instagram, and you'll see it say at RichardFain28. That's where you can DM me if you want that free Webull tutorial video after you open the Webull account, okay? Now let's go ahead, now that we got that out of the way, let's go ahead and dive into the CPI report for September. Now I'm gonna cheat a little bit, guys, because I don't wanna mess up any of this information. So I brought some notes with me. So bear with me while I kind of just read through some of the key points of the CPI report. It's important because we need to know exactly what the direction of inflation is, because that's going to indicate what the Fed is going to do when it comes to increasing short-term interest rates. I always tell you guys, information is powerful. If we have the right information, then we have the best opportunity to move forward when we're getting ready to buy our investments, right? So let's talk about it. The consumer prices rose 0.4% in September, more than expected. All that means is the market expected inflation to not rise 0.4%, but less. And unfortunately, it rose higher than what the market expected it would. Consumer prices index rose 0.4% for the month, or 3.7 a year over year. Expectations were month over month it would go up 0.3%, but it went up 0.4%. Year over year, the market forecasted inflation to go up 3.6%, but yet and still it went up 3.7%. Now that is headline inflation. So when you're looking at it from an average person's point of view, inflation actually went up month over month and year over year from a headline inflation standpoint. Now, when we look at core inflation, where you basically strip out food costs and energy costs, core inflation actually month over month came in at expectations. Core inflation was expected to increase 0.3% month over month, and that's what it did. It increased 0.3%. So that was a wash. Year over year, core inflation was expected to go up by 4.6%, but it actually came in at 4.1%. So that was pretty dang on good. It beat expectations. Now, here's the thing, guys, with inflation. We've been fighting this thing for over 20 months, right? And if you go back to September, actually, if you go back to June of 2022, inflation for the, pandemic era increased to 9.1%, right? So 20 months later, almost 20 months later, it is at 3.7%. So it goes down from 9.1 down to 3.7. That's good news. That's really, really good news for us, guys, because at 9.1%, the cost of our goods and services were just too high. They're still too high at 3.7% inflation, still too high. But guess what? I'll take 3.7 over 9.1 all day. So we've made some progress. How did we make that progress? We made that progress because the Federal Reserve, the feds, continued to raise short-term interest rates over the last 20 months. They went from 0% all the way where they are today, which is 5.5%. That's the Fed funds rate. That's the rate banks borrow money from each other. That's not the rate your bank is going to lend you money, though. Your bank is going to lend you money based on the prime rate, which is 3% higher than the Fed funds rate. Why is short-term interest rates so important when it comes to controlling inflation? Well, what causes inflation? Let's start with that. What actually causes inflation? When there's an imbalance between supply and demand. That's what causes inflation, right? So if I have a small amount of supply, but I have a large amount of demand, that increases prices. And that's what happened after the pandemic broke out. See, when the pandemic broke out back in March of 2020, we had a balance between supply and demand, right? We had a balance. We had just enough supply to meet the demand. But then when the pandemic broke out and the whole country had to shut down, not only did people have to stay inside and limit their access to other people, guess what? The supply chain of our goods and services shut down as well. All of these companies who make these products and services that we use every day had to shut down their manufacturing, right? They had to shut down manufacturing. And then when those companies were allowed to start producing or manufacturing goods and services again, it took a while to get up to speed. But yet and still, the demand was out there. Once we were opening back up the country, people went out and started spending money again, buying things again. The only problem with that was we didn't have enough supply to meet the demand of the American people. And that started running up prices, right? Prices started increasing on that small supply of goods and services that we had because we had a huge, huge demand for them. That's what increases inflation, right? That's why inflation got to 9.1% in June of 2022, right? Almost 15 months after the pandemic broke out. That's what happened. And here's the situation. We're still trying to get that under control today. We still haven't gotten it under control yet, right? We're still struggling with it. That's why the American people have to pay attention to what's going on, right? You have to understand we're not out of the woods yet. And the Fed, in their last FOMC meeting, said the exact same thing. We're going to keep interest rates higher for longer because we want to make sure we have a handle on inflation. We do not want to take our foot off the interest rate pedal just yet, and then inflation turns itself back around and starts moving back upward again, and we're right back in the same boat, and we got to increase short-term interest rates again. So that's why the Fed said in their meeting last month, in September, that they were going to keep interest rates higher for longer. You need to understand why they're doing that. They're doing that because of inflation, all right? How do we help keep inflation coming down? We got to stop spending money on things we don't need, guys. That's the way we can help. That's the way the American people can help. Stop buying things that you really don't need, right? We still have somewhat of a imbalance between supply and demand. We do. That's why inflation is still, core inflation is still 4.1%, and headline inflation is 3.7%, when really it should be at 2%. That's where the Fed wants inflation at, 2%. And right now it's at, like I said, 3.7 headline and then 4.1 core. Now I will tell you, those are, hey, I welcome those inflation numbers over what we had a year ago or 15 months ago or 2 years ago. I welcome that. Why? Because that tells me whatever the Fed is doing and what they're doing is increasing short-term interest rates is working. We got to do our part, though, in order to continue to help it work. If we want the Fed to reduce short-term interest rates anytime soon, guess what we got to do? We got to be fiscally responsible with our money. We can't be taking our money and just spending it on stuff we really don't need. Because that's just going to keep inflation higher for longer, right? That's all it's going to do. Because like I told you, we still have a supply-demand imbalance, right? If we have too much supply and not enough demand, what happens with prices? They go down. See, they go down. When you have more supply than you have demand, prices go down. But the reverse happens when you have a lot of demand, little supply, prices go up. That's inflation, right? So that's what we're looking at right now. The Fed would like to see inflation at 2% a year, where the prices of our goods and services increase on a year-over-year basis by no more than 2%. Right now, it's 4%. It's 3.7% when you include food and energy. That's too much. So they're working towards that. They're going to continue to monitor the situation. This September CPI report, in my opinion, was sort of, I think it's still good news. And the reason I say it's good news is because core keeps coming down. Core inflation is what really the Fed use as their barometer for inflation. And guess what? It's continuing to come down, right? Like I said, you know, it was 4.3 in August, year over year. And then in September, year over year, it came down to 4.1. That's good news. I believe in July, it was 4.7% year over year. So it's continuing to come down, man. That core inflation is coming down, and that's good news for us. But if we want it to come down faster, we got to do our part. We got to do our part, right? We gotta stop spending money on things we really don't need. That's our part. And I know a lot of people are saying, well, hey, man, I hear you, but guess what? The economy is still doing great. What are you talking about? Hey, the economy is doing great, guys, because we're a country of spenders. right? We're a country of spenders. It's not doing great because we have a balance between supply and demand like we would like it to be. It's not doing great because of that. It's doing great because people are just spending money that they shouldn't be spending on things they shouldn't be buying. And that's evident, guys. You look at the savings, the personal savings here in the United States. We went from 2 trillion less than 2 years ago down to less than 200 billion. Where did all that money go? Buying things we don't need, right? Running up inflation after the country started opening up and the pandemic was kind of behind us. People let their hair down. They started traveling again. They started buying stuff they ain't got no business buying. And the personal savings for the United States went from 2 trillion all the way down to 200 billion. Less than 2 years. That's ridiculous. That's because people are spending money on things they don't really need. And all that's doing is keeping inflation high. I'm telling you guys, that's all it's doing. It's just keeping inflation artificially high. It's also going to keep interest rates higher for longer. So if you're someone that says, hey, I want to buy a new home, but I can't buy a new home because, the interest rates are 7.5%, 8%. Guess what? Stop spending money on things you don't need to be spending it on. And the Fed will start reducing the short-term interest rates, and therefore long-term interest rates will come down. 30-year fixed rate mortgage rates will come down as well. But if we don't stop spending unnecessarily, interest rates are going to stay higher for longer. Inflation is going to stay higher for longer. That's where the American people can help. Because that's in our control, right? That's in our control. We have to stop spending money unnecessarily on things we don't need. That is just a flat out truth, guys. You can look at these inflation numbers any way you want to look at them, right? I know there will be some people out there who will look at them and say, hey, we're in good shape. Inflation's coming down. I'm going to keep doing what I'm doing. Okay, guys, inflation is not where we need it to be. I keep telling y'all that. It's coming down. It's better than it was 15 months ago, 18 months ago. It's better than it was then. But we ain't no way, shape, or form out of the woods. Go back and look at the September, I believe it was September 20, when the Fed ended their meeting and the Fed chair, Jerome Powell, made some comments to America, right? And in those comments, if you were paying attention, you would have heard him say, we're not out of the woods yet. We're going to keep interest rates higher for longer. That's telling the American people we're not satisfied with the progress of inflation coming down. That's all it's telling you. And it's also telling you to stop spending. Stop spending. If you want mortgage rates to come down, stop spending money on stuff you don't need. That's how you get mortgage rates down, right? If you want your rent to stop going up, guess what you do? Stop spending money on crap you don't need. Then your rent will come down. Interest rates will come down. Prices will come down. But as long as we're out here still spending money on things we really don't need, it is never going to come down, guys. It's going to stay higher for longer, both rates and inflation. That's where the American people can help. And I believe if we were to do that, inflation would get down under 2% pretty quickly. Pretty quickly. But unfortunately, we have not demonstrated that yet. That's why you got to start paying attention to what's going on in our economy. You got to start paying attention to when these Fed committees meet and what the Fed chair says. You got to start paying attention to these CPI inflation reports that come out. You got to start paying attention to these job reports that come out. You got to start paying attention to that stuff if you want to be a retail investor that knows how to move when it comes time to you to invest your money to build wealth. But if you have no idea how our economy works, you have no idea what goes into making inflation go up or go down, then you're just kind of missing the boat. And again, this is not about trying to be an expert. It's just trying to have some general knowledge of kind of what's going on out here. That's sort of where you want to be at, right? And that's sort of where I'm at. I'm just a guy who has general knowledge of what the economy is doing. And the reason I got general knowledge is because I pay attention. I listen. When the Fed chair has his comments after his FOMC meetings, I listen. And then I go out and I do a little more research online just to kind of figure out what's going on. I'm no expert at why, CPI inflation report. I don't go into detail. I just kind of give you guys the cliff notes, the highlights. Now, what happened with the stock market when the CPI report came out this morning at 8:30 a.m.? What happened to the stock market when it opened? Well, it had modest movement, guys. It didn't really, the market didn't really do very much. And the reason it didn't do very much is because the market had already estimated what the CPI report would do. And it wasn't a bad news CPI report, even though I know headline inflation slightly went up. It didn't beat expectations, right? Remember, I told you it month over month, inflation went up by 0.4%. Expectations was 0.3%. So it slightly missed expectations. Year over year, right? Prices went up 3.7%. Expectations was 3.6%. So that, to me, right there, guys, is negligible, right? I'm okay with that. And the market was okay with it. That's why you didn't see the stock market have a huge sell-off or anything. And then core inflation actually beat expectations. I mean, it met expectations month over month at 0.3%, right? It met expectations. And then let me just look at my notes here because I don't want to miss this one. I think I missed it earlier. It came in at, let's see where it came in at. Yeah, came in at 4.1% year over year, and expectation was 4.3%. So it actually beat expectations for core, missed slightly expectations for headline. But all in all, it was a pretty good report. Not out of the woods yet, but pretty good report. And my thing is, guess who has direct control, in my opinion? This is just my opinion, guys. Guess who has direct control over how inflation comes down? The American people. That's why I titled the video the way I titled it, because the American people have direct control over how fast inflation comes down going forward. They have direct control how fast short-term interest rates come down, which affect long-term interest rates like mortgage interest rates. If you want to buy a home and you're waiting on rates to come down, stop spending money that you shouldn't be spending to help us bring down inflation. I keep telling you guys, we have an imbalance between supply and demand. We still got more demand than we got supply. Even though the supply chain is working itself out and it's gotten much better, it's still a lot of unnecessary spending going on here that we can control as Americans. And that's what we got to start doing, right? We got to take control of our spending, slow down on the spending, and we give ourselves a chance to get this inflation thing down pretty quickly. Probably can get it down to somewhere in that 2.5% range by the end of the year if we would just stop unnecessary spending. Now, we can turn around and try to blame everybody else for what's going on in inflation. The government, they printed too much money. Guess what? All y'all took the money. Everybody that could get the money, when they printed the money, you took it. But now all of a sudden you want to blame the money printing. This is what we do. We want to blame the money printing that was done during the pandemic, right? The stimulus checks, the PPP money. We want to, they printed too much. No, but yet and still, everybody that could take the money took it. Took it freely. But yet and still, we printed too much of it. So my thing is, and my point is, we control this inflation thing. We can bring it down to 2% if we want to. Or we can keep it at 4.1% where core is right now if we want to. We can bring short-term interest rates down if we want to. All we got to do is stop spending money unnecessarily. Inflation will come down, Fed will feel comfortable with it, and they will start bringing short-term interest rates down. The guy already told you, man, the Fed chair. See, if you pay attention, guys, the Fed chair already told you. We're going to keep interest rate higher for longer. Why? Because inflation has been sticky. It's not coming down as fast as we'd like. So we're not saying we're going to continue to raise rates rapidly, but we're going to keep rates where they're at for longer. That's telling you they're not happy with the progress 100% of how inflation has come down, even though it has come down quite a bit since June of 2022. It has, but not to where they are comfortable with it, guys. So here's the deal. Here's the deal what we got to start thinking about as investors, right? Now, why inflation is still quite high. Interest rates are still quite high. The stock market is not going to go into a bull market until interest rates come down. Now, we might have a bounce here and there like we've done over the last year, year and a half. We had some rallies, then we had some setbacks, a little bit of a rally, setback. But it won't go into a bull market until rates come down. Now, according to what the Fed chair has said, their plan is to keep interest rates higher for longer and not start reducing until around June of 2024. I also saw something online where a lot of the so-called experts are saying that the Fed are going to reduce short-term interest rates by 75 basis points in 2024. Now, I'm not saying that won't happen. What I am saying, though, is the Fed will not reduce at all in 2024 if inflation is still, core inflation is still hovering around 4%. You're not going to get a 75 basis point drop. They're just not going to do it. So if you want them to lower short-term interest rates, you got to stop spending and we got to get inflation down. That's the key. Now, until inflation comes down, until interest rates come down, your favorite ETFs and your favorite individual stocks will continue to be on sale. They are. Go look at the stock market today. As you're looking at this live, when you get out of this live, go look at the three major indexes. Before I started this video, 2 of the 3 major indexes were in the red. Dow Jones was in the red and the S&P was in the red. The only one that was in the green was the NASDAQ. So 2 of the 3 major indexes are in the red. All I'm telling you guys is your favorite companies, your favorite ETFs are going to continue to be on sale as long as inflation is higher for longer, and as long as short-term interest rates are higher for longer. See, the stock market cannot flourish to its fullest with short-term interest rates, aka Fed funds rate hovering around 5.5%. It's not, guys. Why? Because companies make up the stock market. There's no magical thing going on in the stock market. It's just companies. And the majority of these companies borrow money to grow. And companies can't borrow money when it's at 5.5% plus whatever spread their lender is going to charge them. They can't borrow money and it make any sense. Right. Every company in the S&P 500 doesn't have Apple's balance sheet, guys, with all this cash like Apple has. Most of these companies borrow money to grow. They borrow money to grow and to become more profitable. Therefore, when they become more profitable, what happens to their stock price? It goes up. So the thing is why they're trading at a discount right now, because they can't borrow money, so they can't grow. They're just kind of maintaining. Why they are trading at a discount, that's when you should be buying. You should be buying right now, in my opinion. That's why I'm buying. I'm doubling down because I know I'm picking up all of these great companies, all of these great ETFs at a discount right now. They're trading in the red. See, the thing is the stock market is pretty simple, guys. When you really take away all the propaganda that's out there, it's pretty simple to understand. It's pretty simple to understand. The goal is I want to buy really good companies, really good ETFs when they're trading at a discount. That means they're trading lower than really what they're worth. That's the key. Now, once I buy them super low, right, I hold them. I just hold them. And guess what? I'm going to probably get a small dividend while I hold them, right? They're going to pay me a dividend if that particular ETF or that particular company who you're buying individual stock of their company, if they pay a dividend, they're going to pay you a dividend while you wait. Now, here's what happens. You're buying all these companies at a discount. Let's give you an example. Let's say you're buying ABC company at $100 a share. And you just keep buying it at $100 a share. You keep buying it for the next, let's say, 12 months. You buy it at $100 a share, $95 a share, maybe it bumped up to $105 a share. You know, you just keep buying it consistently at $100 a share. Then all of a sudden, inflation comes down. Let's say inflation comes down in a year to, let's say, 2.5%. Now, a lot of people don't believe that. A lot of people believe it won't come down under 2% until 2026. I don't believe that, but it's a lot of people that don't believe it'll come down until 2026. I think it'll come down a lot sooner than that. But just for this example, let's say it comes down in a year, it comes down to 2.5%. And then the Fed says, you know something, we're happy with that progress. Let's start reducing short-term interest rates. Let's start heavily reducing short-term interest rates. Let's take short-term interest rates from 5.5. Let's take them all the way down to 2.5. So now the Fed funds rate is 2.5. See, what that does is allows companies now to be able to go to their lender or raise money from the private market, or they can raise money through the public market, through, issuing more shares of their stock and people buying it and create more cash for them to be able to invest. They can do it through debt or they can do it through equity, right? One of the two. Let's say they start doing that. Now all of a sudden they got enough money to start expanding again. And that expansion yields them a 10% return, but they borrowed the money at 5%. See, that's when companies can start growing again and their stock price is going to start increasing. And that's when the stock market starts increasing as well. As the companies that are in the stock market get more profitable, the stock market gets more profitable, because the stock market is only made up of companies. There is no other mechanism that makes the stock market go other than companies, publicly traded companies, whether they be large behemoths like Apple, whether they be mid-sized companies, or whether they be small public companies. It's all made up of companies. And as these companies get more profitable, their stock price goes up. Therefore, if you have an investment in that company, your stock goes up. Remember that company ABC that I bought at $100 a share 12 months ago? Guess what now? Since it's more profitable, guess what? Now it's trading at $200 a share. So for a whole year, I've been buying at an average of $100 a share. Now all of a sudden, boom, it jumps up to $200 a share. Guess what I just did? I just made $100 pre-tax profit on my investment. I'm just telling you guys, that's how it goes. Let's just say I had 500 shares. Those 500 shares have doubled in value if I bought them for $100 per share. They doubled in value in less than a year. Why? Because interest rates came down. That company was able to borrow money cheaply. They took that cheap money, they invested it into their growth, and that growth yielded them a 10% return on their investment, and they became more profitable. That's how the stock market works in a nutshell, guys. Now, I'm no expert on companies or anything like that, but I'm telling you, you don't got to be a rocket scientist to figure out how the stock market works. That's how it works. It's just companies. When those companies become more valuable, if you're invested in those companies, you become more valuable. Your investment becomes more valuable, right? Same thing with ETFs. I invested in Vanguard S&P 5, no, it was Vanguard Information Technology, VGT. I invested in that in September 2020. It was trading at $317 a share when I bought it. I sold it at about $420 a share. I made $103 per share profit when I sold it. I made over $100K in that investment, just like that. That's all it is, guys. The stock market is not hard to figure out. It's put your money in when it's trading in the red, and you do it over a long period of time. And then when it goes back to trade in the green and stays there and keeps going up, which it will, that's when you make your money. What's that called? That's called a bull market. Right now, we're still in a bear market. Bear market is what? When the stock market goes down in value by a certain percentage. Sometimes 20%, sometimes 30%. But overall, we're in a bear market. That means there's a lot of volatility, a lot of red days. Some green days, but a lot of red days, right? When we go to a bear market, you get the reverse. A lot of green days, some red days. A lot of green days, some red days. That's where we want to go. I want to buy in my red. I want to sell in the green. That's it. It's in a nutshell. I don't care how fanatical you want to get and want to look at charts and graphs and all this stuff. Go ahead. I ain't going to look at any of that. All I'm going to do is go find the very best companies in America. And when they're trading in the red, I'm buying them. I'm going to go get the very best ETFs in the country. When they're trading in the red, I'm going to buy them. And I'm going to sit on them and hold them till they trade in the green. And then I'm going to sell them. That simple. I don't care about all this other stuff people be talking about. All I want to do is find the very best ETFs, the very best companies with a proven track record of success. I'm going to buy them on red days, and I'm going to sell them on green days. If I just do that, I'm going to win. I'm going to win in the stock market. That's what history tells me. So this is a perfect opportunity for us who are trying to build wealth. Those of us that are not in the enjoyment stage of wealth yet, we're still in the building stage of wealth. This is the time when you should be considering buying. See, the 1%, they want to trick you. They trick you. They want you to buy when you really should be selling. And then they want you to sell when you really should be buying. So you just got to be careful and not allow that manipulation. So right now, if you're looking at the CPI inflation report for September and you're reading stuff online, you got to be careful. Because you're going to have people out there saying, oh, it's all bad. Then you're going to have people out there saying it's all good. And you're going to be like, I don't know what to believe. Right? You're going to have people, oh, it was terrible. Oh, it was great. Listen, man, don't worry about any of that propaganda. Go to the stock market, see what's red. If it's a blue chip company that you know historically trades green, there you go. That's all you got to do. Go look at an ETF like Vanguard S&P 500 VOO. Probably trading around $400 a share right now. If it's trading in the red today, might be an opportunity to pick it up. But you got to commit to holding it 3 to 5 years. That's what I would do. Right? That's what I would do. In my experience, I'm telling you, I did this with VGT, guys. I did this with Vanguard Information Technology. I did it. I continue to do it with VOO. I continue to do it with Apple. I continue to do it with Tesla. A couple months back, I made a great profit on Tesla. Why? Because I bought it when it was in the red, and I just simply waited and held it until it was in the green. Well, I was comfortable where it was in the green, and I sold it, and I made money. That's how you make money in the stock market. You buy them in the red, you sell them in the green, period. I don't care what fancy charts and all this other stuff these people are telling you about. All you got to do, buy them in the red. Now, you got to buy good companies, though. You got to buy good ETFs. You can't be buying stuff that ain't never performed well and think it's going to get in the green. You got to buy stuff that performs well over time. And if you do that, you give yourself a perfect opportunity to win and win big. In this situation right now where the September CPI report just came out, you can look at it two different ways. You can look at it as a good report. You can look at it as a bad report. I choose to look at it as a good report. But I also understand that the American people can make it a great future report if they stop spending money on things they don't need. Right? Take that money and start investing in an assets that's going to build wealth for you. Because a lot of y'all, when this thing is all over with, in 5 years, you're going to look back and say, man, I missed so much wealth I could have built. Yeah, this guy on YouTube was saying all this stuff. I ain't really paying him no attention. He wasn't a licensed financial advisor. Only licensed financial advisors know what they're talking about when it comes to the stock market. No one else does. So if he's not licensed, I'm not going to listen to him. If he doesn't have a Series 7, if he doesn't have a Series 6, if he doesn't have his 63, if he doesn't have his CFP, how can he know anything about the stock market? Keep on thinking that way, guys. You just stay broke. So you'll stay broke. You'll just stay broke. You better figure out how to think for yourself. You better figure out how to take simple concepts and think for yourself. You don't have to make the stock market as hard as people try to make it seem. It's not. It's companies. Hell, if I go spend $100 a week at Walmart buying groceries from them, it makes sense to me. I like Walmart. If I'm willing to go there and spend $100, $150, $200 a week buying groceries, why wouldn't I simply turn around and buy their stock if I like Walmart that much? I might as well buy Walmart stock since I'm spending $1,000 a month in there. Makes sense to me. Hell, if I'm going to make Walmart rich, they're already rich. If you ever heard of the Walton family who owns Walmart, every single one of them are billionaires, the kids. From Mr. Walton that started Walmart. All of his kids, billionaires. And you, Ryan, here spending $200 a week there, and I won't even buy the stock so you can become financially free. That's why I keep telling y'all, if y'all gonna spend money with these companies, man, listen, spend companies with money who you are willing to buy their stock. Become an owner. I spend a lot of money with Apple because I love Apple's products, but I'm an owner of Apple. See, I buy Apple stock so I can participate in the upside. I'm not gonna be out here spending $3, $4, $5 grand a year on Apple products and I own nothing of Apple. No stock, I'm not an owner. What good is that? So if you're out here buying stuff from these companies, man, listen, think about buying their stock. Become an owner so that when these companies continue to get profitable and their stock price continues to go up, you participate in that upside. Don't just be a consumer all your life. Be a producer. Producers make money. Consumers spend money. That's the difference. Producers make money. Consumers spend money. Don't be a consumer all your life and just spend money. Be a producer and make some money. That's how you get to your freedom, guys. This CPI report, in my opinion, was good news. But I also understand it's not the best news. It doesn't get us out of the woods yet. You got to understand, the Fed has already told you that if you pay attention. We got to get down to 2%. A lot of people say we won't get to 2% until 2026. You're talking about, that's 3 years from now, guys. So if that's the truth, that means interest rates are going to be higher for longer till 2026. Because I can guarantee you this, the Fed is not going to reduce short-term interest rates if inflation stays above 2% that long. Interest rates going to stay higher for longer. So you got an opportunity right here, whether it be 12 months, 18 months, 24 months, 36 months, to continue to buy these companies at a discount. Because once the Fed turns back on the money printer, they turn back on the money supply, stock market is going to the moon. And how do they turn on the money supply? By lowering interest rates. Anytime they lower interest rates, that adds another level of money to the economy. And that level of money, or that supply of money, is borrowing. When people can borrow money cheaply, companies can borrow money cheaply, they turn around and take that money and make more money with it. But in order for that to work, the Fed has to turn on the money supply. They have to reduce short-term interest rates. Right now, the Fed has turned off the money supply because you have no access to borrowing money cheaply anymore. Why? Because interest rates are high. That's why a lot of Americans can't buy a home right now. Can't afford the monthly payment. Not at 7.5%, 8% fixed rate for 30 years. They can't do it. Can't afford it. Can't qualify. Why? Because the Fed has turned off the money supply. A lot of companies can't expand and grow. A lot of them are laying off people. Why? Because they can't expand and grow. They have no money. They cannot borrow money cheap. Money supply is turned off. See, these are just basic concepts, guys. You guys got to know. You got to know that interest rates, the Fed controls the money supply through interest rates. You got to know that concept. They control the money supply through what? Interest rates. Remember when your mortgage rates were 2.5%, 3%? Guess what? The Fed had turned on the money supply. As soon as inflation started going up, y'all started spending money crazy and not having any regard for the low supply of goods and services. And we created all this demand after the pandemic. Guess what the Fed started doing? Increasing short-term interest rates and doing what? Turning off the money supply. Right? They're just taking money out of the economy by not giving you access to cheap money. They take money out of the economy. When they want to put money in the economy, they give you access to cheap money through loans. That's it, guys. So just understand these basic concepts, tie those in with this September CPI report, and you will see that, hey, I'm not going to worry about this. This is an opportunity for me to get out here and buy paper assets and build wealth. Why wouldn't I want to do that? Right now, I'm broke. Right now, I don't have any retirement savings. Right now, I'm not where I want to be. I'm 45 years old, and I'd like to retire in 5 years or 10 years. What a great opportunity to build your wealth, man, in these next 5 to 10 years. It's going to be amazing. But you got to be able to get yourself in the game and start understanding this financial system that we have in this country so you can participate in the financial upside that's going to happen over the next 5 to 10 years. But it starts with you understanding what's going on in the economy and how that affects the stock market. See, a lot of people, oh, the stock market and the economy are two different things. Okay, whatever you say, man. All I know is the economy is made up of what? Companies and consumers. That's it. That's it. Our economy is nothing without consumers and companies. I don't care what else you say. If you ain't got consumers and you ain't got companies, guess what? You don't have an economy. What is the stock market made up of? Somebody tell me what the stock market's made up of. Somebody tell me. I know somebody in here gonna chime in. Somebody tell me, what is the stock market made up of? If the economy is made up of consumers and companies, what is the stock market made up of? And while y'all chiming in, y'all hit that like button for me. Hit the like button. Please hit the like button, guys. I appreciate you. Do me that big favor. Let's get these likes up. Like I said, you don't have to agree with everything I say in these videos or these lives, but if you're here tapping in and you appreciate the grind, guys, hit the like for me. Please hit the like for me. I really would appreciate it. Let's get these likes up. Right now, we're a little bit light on the likes. We got quite a few people in the live, but we don't have, oh, there we go. I see the likes starting to go up now. Thank you, guys. I really appreciate you. I really, really appreciate you. Continue to hit that like button for me. I'm telling you, you guys are amazing. Thank you so much. Continue to hit that like button. Now, let's get back to what I just said. If the economy is made up of companies and consumers, what is the stock market made up of? What is the housing market made up of? Right? What are these other asset classes made up of? I would venture to say they're made up of the same thing that the economy is made up of. Companies and consumers. Now, some people can call them investors. Call them whatever you want to call them. They're still consumers, right? Whether they be retail consumers or institutional or hedge fund consumers / investors. Made up of the same thing, right? Consumers and companies. So in my opinion, the economy and the stock market and the housing market, our financial system is made up of the same things. We may call them different names, but it's still the same thing. People and companies, right? So yes, in my opinion, the economy has a direct effect on the stock market. It has a direct effect on the housing market. It has a direct effect on the labor market. It does. Because all of them are predicated on consumers and companies. So all I'm telling you is, if you think about it that way, you'll understand what's happening, right? You'll understand when our economy does bad, when inflation is high, when interest rates are high, consumers and companies don't do well. Not from a growth standpoint, right? They don't do well. When interest rates are low, when inflation is low, consumers and companies do better, right? They have more access to financial products that they can then take those financial products and do what? Make money. They do, right? Again, back to the Fed turning on and turning off the money supply with interest rates. That's a big important thing you guys got to remember. The Fed controls the money supply in this country. They control the money supply. They can put more money in, they can take money out, right? And they do that through interest rates and a couple other things, but mainly through interest rates. So know that, educate yourself with that, and then go take that information and go build wealth. I've already told you earlier in this live that, in my opinion, and again, I'm not your financial advisor, I'm not quote unquote, a financial advisor or CFP or CPA, I'm none of that stuff. I'm just a normal guy, man, that's been blocking and tackling for 25 years, and I'm free. That's all. I've just been blocking and tackling for 25 years, and I'm free. I know a lot of you, I don't want to wait 25 years. I'll have 25 years. Don't wait 25 years. You ain't got to wait that long. But I can tell you this, if you're going to do it faster, you better figure out a way to make some money. And then you better figure out a way to take that money and multiply it, because that's the only way you get the freedom. You don't get the freedom by just doing a lot of talking, guys. We love talking. We love chiming in and giving our opinion, but yet and still, we ain't free. Right? We ain't free. Freedom comes from having assets that generate enough income to take care of you. That's free. Financial free. Now, you got other types of free, but for me, that's the free I'm looking for. I don't need no I'm free, but I'm broke. I don't need that freedom. I need freedom that includes me not being broke. I want that type of freedom. I don't want no one controls me. I'm living off grid. I'm living on $100 a month, and I'm off grid. I'm totally free. I don't want that kind of free. That's somebody else. I don't need no live off grid and live off $100 a month, and I got no electricity. I got to use the bathroom in a hole. I'm recycling everything. No, I don't want that kind of free. I want free where I have all the creature comforts that I'm used to having, but yet and still, my investments pay for them. That's the difference. I ain't got to go to work. I ain't got to go to work for somebody that I don't like. I ain't got to go to work on the second shift, third shift. I ain't got to be pulling no 12-hour shifts, right? I ain't got to do none of that no more. I ain't got to do that. Why? Because I did one important thing. I took the money that I earned and I put it in investments that grew over time and created what? Net worth. And then that net worth created what? Passive income. And all I did was very simple, very simple, very, very simple. I took money and put it in the stock market through paper assets. ETFs that track the S&P 500, ETFs that track the total stock market, ETFs that track certain industries and sectors. Those are the 3 ETFs that I bought, right? 80% of my money went there. 20% of my money then went to big boy companies that I like, that I use. And I said, if I'm gonna use these companies and spend my money with them, I wanna become a shareholder so that I can enjoy the upside when these companies become more profitable. So that's what I did. 80% of my money goes into ETFs in those three fashions, right? Track the S&P 500, track the total stock market. I put money in ETFs that track certain sectors, healthcare, tech, right? And then 20% of my money went into individual stocks of companies like Tesla, Apple, Bank of America, Wells Fargo, NVIDIA, Meta, right? Companies like that. That's all I did when it came to paper assets. Very, very simple, but very, very effective, right? Very effective over a long period of time. And then the next thing that I did, I bought real estate. Wasn't a real estate mogul. Didn't have $100 million in real estate. Nope, I did not do any of that. All I did was something really simple. I said, you know something? Every 2 years, I'm gonna buy a single family home in a really good location. Not an expensive location, not a wealthy location, not on the water, not over mountains, not any of that. Just in good, plain Jane, white collar / blue collar, good neighborhoods where people had a desire to live. Decent schools, decent amenities in the surrounding area, low crime, right? I just bought real estate in those type of neighborhoods that I would live in. I never bought real estate in a neighborhood that I wouldn't live in myself because I wanted to attract tenants who were fiscally responsible like me. That's the game plan. That's what I follow. Every 2 years, I'd buy one of those houses, a little 3-2, stick a tenant in it in a good neighborhood. And guess what happened? Over the course of 10, 15 years, all of those properties did what? They provided immediate cash flow through rental income, and I took that rental income, I paid my expenses, and guess what else I did with the rental income? I didn't go buy crap that I didn't need. I would save that. I would put it in a savings account as a reserve. I would reserve that money for capital repairs on the property, and then I would reserve that money for the next property that I was gonna buy in 2 years. See, I didn't take the cash flow and go live on it and spend it and go on trips and all this other stupid stuff people do when they ain't when they're not in the enjoyment stage of wealth. I didn't do that. I took every penny and I used it for the next property that was left over for me servicing the expenses. But see, that wasn't the real money. A lot of people miss this. That was not the real money in real estate. The real money in real estate for me was the appreciation of the property over time. So if I bought a property for $200K and I held it 10 years, and when I got ready to move that property to get into another property, it was worth $350K. I just made $150,000 in profit that I would roll over into the next property, or 2 properties, or 3 properties. That's where the real wealth came from for me. That's where the real net worth gain came from. It wasn't from the rental income because I didn't own enough properties. Now, had I had a 100-unit apartment complex or a 200-unit apartment complex, then the cash flow would have made sense, right? Because why? It's scale. You know, if I got 1,000 apartments, yeah, I'm gonna make a bunch of money because I got scale. But when I got 5, 6, 7 properties and they're just single family homes, there ain't no scale. There ain't no, and all of them got loans on them. So there ain't no scale when you got 5 or 6 single family homes, properties. What you hang your hat on in that situation is the appreciation of the properties. And that's what I did. Because I never owned more than 10 properties at once, guys. Never. Why? Because I never looked at myself as a real estate mogul or a real estate, The only reason I bought real estate is because I knew if I could do 10 properties and I can get a $100,000 increase in property appreciation, just $100K on each property, and I got 10 of them, guess what? I just made myself a 7-figure net worth. Yeah, that's what I did. I just made myself a 7-figure net worth over a 15 to 20 year period. I created 7-figure net worth out of zero by owning little single family home properties, buying one every 2 years, just made myself a pre-tax gain of $1 million just on appreciation. That's how you build wealth over time. So I didn't have no lot of money. Oh, golly, you had $300,000 to start with. No, I didn't. I had zero. When I was 26 years old, I was dead broke. Didn't even have a job. 26 years old, no job, no net worth. But I learned something. I learned discipline, I learned patience, and I learned consistency. Those three things have changed my life. A lot of us don't have those three things. We want everything right now. We don't want to work for nothing. We want it all right now. Instead of us going out and getting one little single family home and starting with that, we want to go get a 10 unit. Ain't never bought real estate, ain't never managed real estate, but we want to go buy a 10 unit. No, go get you something that you can learn from. And then if you want to elevate to a 10 unit, go get a 10 unit. But if I'm brand spanking new, I don't know nothing. I ain't never bought nothing like that. Why would I try to start with that? Why wouldn't I just start with something that I can learn and then elevate myself to a 10 unit or a 20 unit or a 50 unit? See, we try to bite off more than we can chew a lot of times. Gotta stop that, man. We gotta stop trying to bite off more than we can chew. We gotta start just doing the fundamentals, the basics, and then grow into something, right? If we do that, you can win. Those were the two things that I did, guys, to build my wealth over a 25-year period. And now, when I'm in the situation I'm in now, I'm in a business. I own my own business, and I'm continuing to build my wealth through this business. And part of my business is doing these educational videos. That's part of the business model, right? That's part of the business model. So I love doing this. That's the reason I do it, right? And I love and appreciate you guys tapping in. It's been real. I'm gonna get ready to wrap this thing up. I know I've been long-winded, but I just wanted to give you guys some background on how to build wealth, man. It ain't hard. The hard part is just being consistent, being disciplined, and being patient. That's the hard part for a lot of people. Because while we're conditioned not to be disciplined, we're conditioned or programmed not to be consistent. We're programmed not to be patient, right? We've been programmed not to do any of those three things throughout our life, right? Because our financial system in this country is predicated on 99% of the people being impatient, 99% of the people being inconsistent, and then 99% of the people not being disciplined. That's what our financial system is built on. They're built on 99% of you guys throwing those things out of the window, getting your little paycheck and spending every dime of it. And then go run up all your credit card limits. Run them up, right? Have no savings, no retirement. That's how our system is set up. All for what? 1% of the population to prosper. I'm telling you, you don't have to believe me, but I'm telling you, that's where the system is set up. The system is set up just like that. It's set up for 1% of the people in this country to prosper, while 99% work like a dog and never prosper. You ain't gotta believe me. Go out there and do your own homework. Go look at some statistics. Go look at some retirement statistics when it comes to retirement savings for America. Go look at those statistics out there online. You'll see about a third of the population got zero in retirement. Nothing burger. They're waiting on Uncle Sam or the government to take care of them from Social Security. That's what they're hanging their hat on. Go look at another statistic. 61% of people live paycheck to paycheck. Why is that? Programming. They're programmed to do what? Go to work, make that money, and then spend it on things. The person with the most things win. That's what they're programmed. And most people fall into that trap. 99% of people fall into that trap. I used to be in that trap. When I was 26 years old, I was in that trap. I was dead in that trap. I ain't gonna lie. I was in that trap. But I just changed my programming. I just changed the way I thought, because I said to myself, if I don't change, I'm gonna have to work for these people for the rest of my life. I'm gonna be some 70-year-old joker going to work. Now, don't get me wrong. If you're 70 years old and you love your job and you want to go to work, hey man, my hat's off to you. Keep going. I didn't want to work when I was 70. Matter of fact, I didn't even want to go to work anymore when I was 50. When I was 50 years old, I was done. I didn't want to go to work when I was 50. Matter of fact, I didn't want to go to work when I was 35. Matter of fact, I didn't want to go to work when I was 26. But I had to. I had to. I had to. I had to go to work when I was 26. But guess what I said to myself? Hey, by the time you're 50, you're going to be free. You're going to be free. And guess what? I was. See, I was. I didn't have a financial background. I didn't go to college and study finance. I didn't go get my CFP. I don't have a Series 7. I'm not a real estate tycoon. I'm not none of that. I'm none of those things. I was not very good in school. I didn't like school, not from the educational standpoint. I liked school because I liked sports. And I knew, I can't play sports unless I take school a little bit serious, because these people ain't gonna let me play. If I got all F's, they're not gonna let me play. So I can't get all F's. I'm gonna get all C's. And I'm gonna be able to play. 2.0, that's all I needed. And I was such a good athlete that when the colleges came, they said, "Woo, he ain't the sharpest knife from an education standpoint in the drawer, but golly, he's a phenomenal athlete. We're gonna give him a shot." And guess what? I got a full ride to the University of Florida on a football scholarship and killed it. Went to the NFL for 3 years, busted my ankle, done at 26, got home. Since I didn't have any financial education, since I didn't have any financial literacy growing up, since I knew nothing about money growing up, none of my family knew anything about money. I blew through all that little money I made in the NFL, and I was dead broke at 26 years old. And I had to make a choice. I can keep myself a part of the 99% where I'm broke with no financial security, or I can start thinking like the 1% and build wealth and be done in 20 to 25. I'll be done with this rat race. And that's what I decided to do. I started reprogramming the way I think, and I started thinking like the 1%. Even though I'm part of the 99%, I thought like the 1%. And that's what I'm telling you guys to do today, and then I'm gonna sign out of here. Even though you may be today a part of the 99%, change the way you think and start thinking like the 1%. See, 99% work to buy things. 1% work and earn to buy investments that at some point generate income to pay for their lifestyle. That's the difference. 99% work to buy things, right? 1% work to buy investments that generate passive income. So although I was part of the 99%, I transitioned, I reprogrammed, and I started thinking like the 1%. I said, no, I'm not gonna take my paycheck and buy this thing. I'm gonna take my paycheck and I'm gonna take a portion of it and I'm gonna put it in the stock market. No, I'm not gonna take my money and buy this thing. I'm gonna take a portion of that money, start setting it aside, and I'm gonna buy me a piece of real estate. And I'm just gonna rinse and repeat that process over the next 20 years and build me $1 million net worth from zero just in real estate. Not the stock market portfolio, but just the real estate. And I told you how I did it. 10 single family homes over the course of 25 years. Each one of them with an average of $100,000 appreciation. Boom, millionaire, just like that. And I started with what? A $68,000 house, 3.5% FHA loan. Lived in that house for 2 years, moved out, put a tenant in it. That was my first rental property. So I tell you guys, oh, you ain't gotta go jump right into a rental property. No, the first house you buy, get it low, live in it, build some equity in it, then move out of it. Take all the equity and buy the second house. Down payment on the second house, rinse and repeat. That's all you gotta do with real estate, right? Don't buy real estate in a neighborhood you wouldn't live in, right? That's where you reduce your risk of having bad tenants that don't pay you. I never had a tenant that didn't pay me. Out of 25 years of doing real estate, I never had a tenant that didn't pay me. Why? Because I always did what? I bought properties in communities that I would live in. And then before anybody got into my property, I pre-screened them. See? I wasn't just looking for the rent check. I was looking for appreciation. The rent check was fine, but I knew the appreciation was gonna bring me more. And I said, you know something? I'll pass on some tenants that I believe are gonna be headaches. Let me find me a tenant that ain't gonna be no headache, get my rent so I can keep my house good and get this appreciation so I can get the freedom. And that's what I did. So all I'm telling you guys is look at the CPI report any way you wanna look at it. It doesn't really matter. It doesn't really matter, right? We can look at it as good, we can look at it as bad, look at it how you wanna look at it. Me, honestly guys, when I see the CPI inflation report, I glance over it, I see what direction it's going, and it don't change my game plan at all. My game plan is what? As long as my favorite companies, my favorite ETFs are trading in the red, I'm buying them. Because I know happy days coming. I know at some point, the tide gonna change. And boy, we're gonna be back at that bull market. And boy, I'm gonna be so happy because I'm gonna have so many companies and ETFs that I've bought over these last 2 to 3 years that trading at a discount. They're gonna be trading at a premium, and I'm just gonna continue to increase my net worth, man. I know happy days are coming. I keep telling y'all, just put your head down, delay gratification, buy these assets, buy these assets. Good days are coming. Just hang on, be disciplined, be consistent, be patient. Happy days are coming. If you do that, you're gonna win and win big, man. Hit that thumbs up for me as I tap out of here, guys. I appreciate you stopping by for this hour. I know it was long-winded, but y'all know I get passionate about this stuff, and I love these lives because I get to just unfiltered, no edit, just get down to the nitty-gritty, right? I just get to the nitty-gritty and say whatever I want to say, and guess what? Can't edit it out. It just in there, and I'm okay with that. I love it. I love it. I love it. But hit that thumbs up for me, and I appreciate you guys for tapping in. Hopefully you learned something about the CPI report for September that just came out. Again, guys, go online. There are more, quote unquote, more smarter people, more financially educated people than me that can tell you anything you want to hear. Go out online, Google September CPI inflation report, and a whole litany of things will come up. And then you can just dive in and believe whatever you want to believe. But I'm telling you what my belief is. I'm telling you what I believe is going to be happening. You can go out and make your own decision, right? You don't have to listen to me. I'm just a guy on YouTube, right? I'm just a guy on YouTube. But I can tell you this. I'm free. I'm free. You see me, guys. Y'all know how I roll. Ain't no fancy production. Ain't no shaving. I don't care nothing about any of that. Because I'm free. My whole goal here is to tell people the message of freedom. The message of financial freedom. That's my whole goal on this YouTube channel. Every single day, my job, let me take that back. It ain't even a job. My pleasure, right? My pleasure is to get out here and give you guys my opinion. It's not a convince you channel, so I don't care if you don't believe me, because it's not a convince you channel. That's why I don't have a bunch of illustrations and show you this, watch this. I don't do any of that crap in my videos for the most part, because I don't care about any of that. All I care about is getting my opinion across to you guys and getting you to think. Your job is to get out there and do your own research and your own fact finding. That's not my job. That's your job. My job is to get you to think. Your job is to get out there and think, and then figure out a pathway to get you to your freedom. The one that has freedom at the end of the day is the one that wins. It's not the one who has the most things. The one who has the most things is typically the one that's going to work for the rest of their life, because they got to pay for them things. The one who gets to freedom, whose assets are large enough to generate enough income to pay for their lifestyle, that's who wins. I told you, 99% of the people do what? They work to buy things. 1% of the people work to build wealth through assets that create what? Passive income that takes care of them. Hopefully you will transition the way you think, reprogram the way you think, and start thinking like the 1%. You ain't got to be 1%, but think like them when it comes to building wealth. I'm not a 1%er, but I think like them. And it's helped me build my wealth. I'm a 99%er, and I always will be. And I'm okay with that. But I built my wealth like the 1%. So I want you to do the same. So hit the like button as you check out of here. Also share this video. Very important. Share it out to your network. I don't care where your network is. Share it with them, right? Somebody out there in your network is struggling with their financial situation, guys. Even though you might think you're great with yours, you may not think you're struggling, right? You may not think you're struggling, but there is somebody in your network that's struggling with finances. And by you sharing this video, they might find a nugget. They might find a financial nugget that changes everything in their life. And that will be all thanks to you because you shared the video. So please, guys, share this thing. Share it with somebody. Just make that a commitment to yourself that you're going to help somebody today. And the way you're going to help them is by sharing this content, because they may be able to find a financial nugget or two in it that could change their financial life. So do me that favor. Also, if you're interested in that Webull offer, click on that Webull link down in the description box. See, Webull's going to give you up to 12 free stocks. Big boy companies, guys. Blue chip companies, guys. Publicly traded companies. They're going to give you up to 12 of them just by signing up, putting any amount of money in your new Webull account. Boom, in a couple of days, once you make your deposit, in a couple of days, boom, you're going to see the free stock. All you got to do is go claim it, and it'll populate into your brokerage account. Now, from there, you want to start building wealth. You want to use the Webull app to build wealth. You want to use the Webull app to buy ETFs and buy individual stocks. Now, if you don't know how to use a brokerage app or Webull's brokerage app, if you can't figure it out, no problem. All you got to do is DM me on Instagram at RichardFain28. My Instagram handle is down in the description box of this video. Just go to the description box of the video and you'll see my Instagram handle. You'll also see my email address from my company, RF Financial Consulting. You can email me or you can DM me and say, Richard, I've opened that Webull account. I've funded it. Send me that free Webull tutorial video so I can learn how to use the Webull app to start building wealth today. And I'm going to do that for you. Why? Because y'all rock with me. I appreciate you rocking with me. And I'm going to do everything I can in my power to help you get to freedom. Because I know what it feels like to be financially free. Control 100% of your time. Control your own financial destiny. I know what it feels like to have that refreshing feeling every morning when I wake up and I get out of bed and I go look in the mirror, wash my face, brush my teeth. Well, I don't brush my teeth always in the morning. That's not the truth. Later on in the morning I do, but not normally when I wake up. So I digress, but let me get back to my point. My point is, it's no feeling like it to know when I get up in the morning, I get to do whatever I want to do. I'm gonna tell you something, guys. If you don't know that feeling, you gotta get there. When I get up in the morning, guys, nothing populates my mind about work. Nothing populates my mind about how I'm gonna pay for something. Nothing populates my mind about any of that financial stuff. Nothing. Why? Because I paid the price. I paid the financial price. I built wealth, and now I'm free. So all I do when I get up now is I just figure out ways to help people, whether that be through the YouTube channel, whether it be through Instagram, whether it be through Facebook. I'm always making content for all those platforms. Although YouTube is my biggest platform, followed by Instagram. That's where I spend most of my time during the day. And I love it. It ain't work. I'm sitting out here on my patio with a beautiful scenery, just enjoying life and trying to help you guys get to that feeling. If you don't know what that feeling is like, guys, you gotta experience it before you leave this place. Because we all leave in this place. We're only here a short period of time. And I would just hate for your short period of time here to be spent working for somebody, not being able to have true ownership of your time, not really being able to control your financial destiny. We're only here for a short period of time, guys. We should not spend it on that hamster wheel. We should not spend it on the hamster wheel. That's the way the 1% want us. They want us on that hamster wheel for the rest of our life. We got to get off that hamster wheel. We just got to press stop and step off of it. Reprogram the way we think and you can get there. I'm gonna be here every day to help you. Every day God gives me breath and sound mind, I'm gonna be making these videos. I don't care if I'm some 75-year-old joker out here making YouTube videos, I'm gonna be doing it. Why? Because I love doing it. It ain't work. It's helping people. And I know, if I help enough people get what they want, I ultimately get what I want. That's the key, guys. You help enough people get what they want, you ultimately get what you want. Keep that one close to you. Keep that one close to you. Write it down. Help enough people get what they want, you ultimately get what you want. Thank you guys for stopping by the channel. Thank you guys for all your support. Thoughts become things. If you can see it in your mind, you can hold it in your hands. You guys keep chasing your greatness. Never stop believing in yourself. And I'm going to catch you on the next live. I'm going to catch you on the next video. Peace.